is a relatively short video on capital leases where the lessee records depreciation associated with its capital leases. Now, before we go on, it may be useful to look at the overall accounting for capital leases in terms of journal entries and see what journal entries occur and where they occur within the financial statements. So let's take a look here. We have the financial statements on the right, our balance sheet and our income statement. On the left-hand side, we have our first journal entry where the organization or the entity recognizes the obligation when it enters into a transaction for a capital lease. So this involves the initial measurement of the lease obligation. We're going to have a debit to the leased asset itself and a credit to lease liability. Now, if we trace those, the leased asset is going to go and is going to be valued typically on or near fixed assets under leased assets on the balance sheet. So there is a value to the leased assets. Also, there will be a liability of the amount that we owe for the leased assets, and that will be recorded as a liability on the balance sheet. So these leased assets will occur or will basically be recorded on the balance sheet as assets and liabilities. Now we take a look at the entries that the leased asset generates eventually. And what we're going to do is, because we have a leased asset on the balance sheet, we're going to depreciate that asset. And we're going to recognize that by debit depreciation expense, and that amount will go to the income statement as an expense, and a credit to allowance for depreciation, which is a contra account to the leased asset account on the balance sheet. From there then, our lease liability generates the entry where we record our rental payment, and we also record the amortization of our lease liability net of our interest expense. And again, what will happen is we're going to see interest expense will be recorded on the income statement, and our lease liability will be recorded as a reduction of our lease obligation on our balance sheet. So for our purposes, in previous videos, we've talked about the amortization of our lease obligation, the interest expense, lease liability, and cash rental payment. Now we're going to spend some time talking about the other portion of the entry where we're going to depreciate a leased asset. So let's go forward and take a look at that. And the rules are relatively simple. Basically, if a capital lease is capitalized under capitalizing criteria, it providing a transfer of ownership or contains a bargain purchase option. In other words, one of the two of the four criteria, you would depreciate the leased asset as you would depreciate any other similar asset over its ordinary economic useful life. On the other hand, if the asset is capitalized under the following capitalizing criteria, meaning if the lease term is for 75% or more of the leased asset's economic useful life, or the present value of the minimum lease payments are at least 90% of the fair value of the leased property at the inception of the lease, the leased asset will be depreciated over its lease term. So let's go through with an example. At the beginning of the year, Zenez Corporation entered into a three-year lease for a machine where the cost of the lease was $100,000 per year. The machine had an economic life of 4 years. The fair value retail price of the machine was $250,000. The company could borrow funds at 12%, and the implicit interest rate was 10%. This is the same information we used in previous videos in terms of an example. And again, if we calculate the present value of our annual minimum rental payments, which is all we're going to need to value the lease, it's going to come out to $248,690. So we would debit leased property for $248,690, and we would credit our lease liability for $248,690. And the reason we know that is because we've looked at the criteria we've reviewed the criteria for a capital lease. Criteria number one, it provides for the transfer of ownership. Okay, in this case, there is no indication there's a transfer of ownership of the lease. It contains a bargain purchase option. There's no indication in the wording of the problem that there's a BPO. So we go to a criteria number 3 or 4, and both criteria 3 and 4 are met. So in this case, when we depreciate this leased property, it's going to be depreciated over the lease term. So we take the $248,690 value of leased property, divide it by the 3-year lease term, and that means our depreciation expense per year will be $82,897. And again, assuming no salvage value or anything else. So our debit to depreciation expense would be $82,897, and a credit to allowance for depreciation would be $82,897. Okay, now let's go ahead and try the one question here on lease depreciation for the lessee. On the first of the year, a company entered into a 9-year lease agreement. The lease was characterized as a capital lease. The asset had an estimated useful life of 12 years. Semi-annual lease payments of $44,000 are due every January 1st and July 1st. The present value of lease payments at 12% was $505,000, which is also the sales price of the asset. What amount should the lessee recognize as depreciation expense on the equipment in the current year? So again, review the question, stop your video, and when you're ready to review the answer, start your video again. Okay, the answer to number 1. The question is, what amount should lessee recognize as depreciation expense on the equipment in the current year? And the answer is D, $56,111. If we go back and look at the individual lease criteria, what we're going to see basically is that criteria 1 and 2 are not included anywhere in the criteria established in our problem. However, criteria 3 and 4 are included in the criteria that we've established in our problem, where our economic useful life is 75% and the present value, $505,000 present value of the lease payments divided by $505,000 equals 100%. So in this case, the instructions are to depreciate, or the rules are to depreciate the leased asset over its leased term. So again, we know our annual payments are $505,000. I'm sorry, the present value of our lease payments are $505,000. So in this case, we have 9 years remaining on our lease term. So we'd take the $505,000 present value of the lease payments divided by the 9 years of the lease, and the answer would be $56,111. And with that, that would be the end of our video on capital leases, lessee depreciation associated with capital leases. Our next suggested next video would be leases. Now in this case, lessor capital leases and direct financing leases. So again, thank you for your time.